the article presents a personal journey into mutual fund investing, emphasizing the value of research and intelligent fund selection. The author shares their early experiences of living on a tight budget in the US, where they learned the importance of financial literacy and investing. The author highlights their transition from a limited budget to investing in mutual funds to secure their financial future. They express gratitude for their physics Ph.D., which enabled them to quickly grasp complex topics like investing. In the early 1990s, they embarked on a journey to learn about mutual funds. This learning process led them to the Morningstar Mutual Fund Directory, a comprehensive resource for mutual fund information. The directory provided in-depth analysis of mutual funds, including performance, risk, fees, and portfolio holdings. It also offered valuable tutorials on how to select the right funds and allocate investments across asset classes. The author shares their early experience with an active, aggressive growth small-cap fund, which initially performed well, but later revealed management favoritism towards institutional investors over individual investors. However, the key lesson for the author was not to discredit active management entirely, but to emphasize the importance of fund governance and placing shareholder interests first. The article acknowledges the long-standing debate between active and passive mutual fund strategies. It mentions that renowned investors like Warren Buffett and John C. Bogle often advocated for low-cost index funds. Academic studies have also shown that actively managed funds tend to underperform their indexes over the long term. The author outlines their personal criteria for picking mutual funds, which allowed them to achieve returns 1.5% higher than the market average with lower volatility. They conducted a comparative analysis of active T. Rowe Price and passive Vanguard funds, finding that the active funds had outperformed the passive ones over 3 distinct 5-year periods. The article then explores recent research findings by Morningstar, showing that more than half of active funds outperformed passive funds over a 12-month period. However, the statistics varied when considering 10-year performance. For instance, 10-12% of U.S. large-cap value, blend, and growth funds succeeded over 10 years, while small-cap and global real estate funds had higher success rates. The author concludes that both active and passive strategies have their merits, but it's essential to have a clear selection criteria and a long-term perspective. They stress the importance of consistency in an investor's approach and suggest focusing on funds with proven processes and risk-adjusted returns. Finally, the article highlights the significance of even a slight outperformance, showing how a 1.5% annual advantage can lead to substantial gains over several decades, making a strong case for intelligent mutual fund selection. In summary, the article reflects the author's personal journey into mutual fund investing and their exploration of the active versus passive investing debate. It underscores the importance of research, fund selection criteria, and long-term consistency in achieving financial success.